Okay, well, it looks like we've got a few people in now. We might get this rolling. Excellent. Well, if everyone, so it looks like I'm just watching the screen here. It looks like most people are connecting. I'm hoping everyone can hear me. We're all fairly used to this this modern world of Zoom and online meetings, hopefully. Now you should all be able to see there's a chat box down the bottom, so please feel free to jump in and to shoot any questions. We've got a fairly small crowd today, so we can deal with questions. I'm happy to deal with questions as we go. And maybe I'm hoping the small crowd is a reflection on maybe a fairly uneventful budget, and maybe not a reflection on everyone's enthusiasm to listen to me talk for a little while. Anyway, be that as it may. So we'll run through the 2022-23 budget, which was obviously announced last week. Otherwise known as, I guess, ScoMo's pre-election cash splash, which has been pretty widely portrayed in the media. Okay, so obviously that's me. I'll also get a big part of this budget, which did take us a little bit by surprise, was the digital transformations and the tax breaks around digital transformations. So I will have, for those of you that know me well, probably know that I'm not allowed to talk about IT, other than the tax consequences, of course. So we will get Sean Edmonds. Sean Edmonds is the principal of DO2 Digital Advisory, and ranked quite. I know Sean and his team are very proud of this. Ranked by CRN Fast 50 as the 14th fastest growing IT business in the country for 2021. So I will invite Sean towards the end of my chat to just talk a little bit about what he's seeing in the IT space, and really then thinking along the lines of well, you know, there'll be some tax breaks around some of this IT spend at the moment. Okay, so fantastic. So obviously the disclaimer, this is general advice only. Don't take this as personal advice without talking to a trained professional first. Hopefully that's me or one of the MBA team. The agenda, so here's the topics we'll run through. Financial outlook, we'll then talk about the personal tax payments, super, retirement, business measures, etc. I mentioned then Sean will invite Sean to chat a little bit about IT and questions. As I said before, I've got some question time allowed at the end. This shouldn't take all that long because we allowed an hour for it, but as a lot of people may be aware, there wasn't all that much in the budget, so we might knock it over a bit quicker. I have allowed for question times, but question at the end, but please feel free to jump in and using the chat box and fire any questions as we go. Okay, we're going backwards. Now we're going forwards again. Fantastic. Okay, happy days. The very big economic outlook. So with our tax hat on, we focus a lot on the tax issues that are wrapped up in the budget, but it's also it's an important document. It's a sense of where the government think the economy are going. Now, those amongst us may argue or may dispute, well, does anyone really have an idea where or does anyone really know where the economy is going? But for what it's worth, here's the government's view of what's happening. GDP growth, so that's real GDP growth, which in plain speak is economic growth over and above inflation. So if you think inflation's running at 3 to 4%, real growth running at anywhere from 4, 3, and then down to 2% over and above that number, that's some fairly high forecast economic growth rates, which is interesting. And again, you may have heard in the media the last couple of days, certainly the Liberal Party making an election issue of our economic growth, and those numbers, sort of by worldwide comparison at the moment, are strong numbers. Inflation, anyone that's been to Woolies has seen this, or anywhere else. My car insurance renewal came through the other day. Inflation is certainly with us. What's interesting in those numbers there is the forecast that inflation will peak this year and then start dropping. I guess that will be, time will tell. Wage growth forecast to increase. Just anecdotally, a lot of clients we're talking to at the moment are really relaying that wage growth is happening, that wages growth is coming through. We're seeing it across a lot of industries, a lot of different businesses. So that's interesting. Unemployment numbers, hit by historical standards, very low, which is clearly fantastic, and forecast to keep falling again. Again, the flip side of that, and I know, looking at a couple of the names and a couple of people that are on this call, the flip side of low unemployment is, in some industries, labour shortages. So whether that will normalise a bit once borders open up. I was talking to a migration agent client last week that said that there's certainly movement there to open up visa and migration rules to start sort of addressing labour shortages. We're seeing it across a lot of businesses. And the annual budget deficit, we hear a lot about this. Now that is that deficit, 79, and it is B for billions. That is the amount added to our debt roughly every year. So the total government debt, I think, is now in the trillions, or pretty close to $1 trillion. But that's the amount that we're going into the red every year. Okay, so I'll talk now about so we'll get onto the tax stuff now. So the next couple of slides are all about the tax consequences for personal taxpayers. We'll get to businesses later. So for all of our individuals, the low and middle income tax offset was basically increased by another $420. So really what that slide, there was already a low and middle income tax offset of $1,080. It's basically been increased to $1,500. That will pretty much apply to everyone. So the majority of people, income over 37,000 through to 90,000, will get the full 1,500. Once you go over 90,000, that starts tailing away, and once you go over 126,000, then there's no offset at all. These offset, or the extra $420 won't be added to your pay packet every fortnight or every week. It will just be added as a lump sum to your tax refund at the end of the year. Okay, personal tax rates. I've got that slide there really just to say nothing's changed, which was, given the number of times tax rates have changed over the last couple of years, that was a sort of unusual. So tax rates are exactly the same and won't change again until 2024-25. Now, what is interesting, I've got it there down in the fine print at the bottom of the screen. What is interesting is, come 2024-25, now assuming, maybe unrealistically, assuming no one changes any of these rates between now and then, the 30% tax rate will apply to everyone between basically from $45,000 or right through to $200,000. So that is particularly for higher income earners, maybe over that $100,000 income level, that there's going to be some fairly substantial tax cuts then in a couple of years' time, and that maximum tax rate of 45%, when we get these new rates in 3 years' time, that won't kick in until you've earned $200,000 of income. So, which is, fairly interesting. So that's going to be interesting to see how that plays out. I can't help but think there's a lot of water to flow under the bridge between now and then, and will it look the same in a few years' time? Who knows? But anyway, that's those tax cuts are legislated. So that law has been passed. Again, we'll see if it gets changed. But anyway, that is what it is for now. Okay, cost of living payments. So these were these one-off payment, $250, tax-free payment as well, to pretty much anyone receiving any pension or government support. Planned to be paid in the month of April. So that's a list there of the main ones. That's not everyone. So age pension, disability, parenting payment, carers payments, job seeker, etc., etc. Any seniors health card or say veterans cards as well, veterans benefits. So anyone receiving any of those benefits or any of those pensions or government assistance is entitled to their $250 tax-free payment, which I was going to say stand by your letterbox for the month of April, but yeah, maybe it will be done electronically and not mailed out, I would suspect. Affordable home ownership, not technically. I've included just simply because there weren't that many tax changes in the budget. I've also included a few of the non-tax measures as well. So affordable home ownership. So basically what this is a government scheme which is already in existence. It's just been expanded for the next couple of years. And it effectively allows certain people that fall within certain categories to buy a home with a smaller deposit. And the way that works is that the government guarantee basically up to the first 20% of the loan. You then take out a normal loan. So you take out a normal loan, but that government guarantee sits behind part of the loan. So that just then gives, say, CBA or NAB or whoever comfort to, instead of lending you 80%, lend anywhere up to 95, 98% of the cost of the purchase price. Okay, so what does that mean? So for the next 3 years, up to 30 June 2025, this program's going to, sorry, I'm just playing with the screen there just so you can see more of the slide and maybe less of me. So for the next 3 years, up to 35,000 per year, so 35,000 loans the government will guarantee, and that's targeted at first home buyers that have a deposit from anywhere from 5% and upwards. So if you're a first home buyer and you've got 5% together as your deposit, then the government will or may, if you fall within the 35,000, may then guarantee part of the loan. The way the process works, you just make a normal loan application through your bank or your broker, and then they sort out whether that government guarantee applies. There's 5,000 guarantees have been set aside for single parents with children, and that's for anyone with a deposit, within that category, anywhere with a deposit from 2% upwards. So it's enabling single parents with kids to make it a bit easier to get into the housing market. And 10,000 places have also been, or guarantees have been set aside for people wanting to buy in regional areas. You don't have to be a first homeowner for this one. You can't have owned for the last 5 years, so it's your first home within the last 5 years, and if you're buying within a regional area. Okay, a little bit in the superannuation space. So the minimum, if you're on a superannuation pension, so to be crystal clear, we're talking now about a super pension, so a pension paid out of your super fund, not to be confused with an age pension paid by the government. So if you're drawing down a pension from your super fund, which lots of our clients are, a million tax benefits around doing this. So any of our clients, anywhere from sort of age 60, more usually over age 65, the minimum pension under a normal year, if you're under 65, you normally have to take out 4% every year to meet these pension standards. For this year and also extended for next year, you only have to withdraw 2%. Basically what that means then, and the strategy around that with a lot of our retiree clients will be to receive all the tax breaks of being on a pension, you'll have to take less money out of super. Now, again, for a lot of our clients, superannuation being so tax effective, a lot of our strategies are really around maximising the amount of money that stays within super. So by default then, reducing what you pull out every year and keeping more money within the super system for a lot of clients and a lot of taxpayers is quite often tax effective. So that's a positive change. These rates, the 2%, the 2.5%, depending on what age you're in, these rates are already in place for 2022, for the current financial year. The change was simply to extend that for another year. What you can see is under the normal rates, once you start getting age 95, if you're still on a pension, if you're still lucky enough to be kicking around and drawing your pension at age 95, you do have to take out 14% of your super balance every year, or 7% under the temporary rules. Now, it didn't change during the budget, but that last dot point, I did put that in there just as a reminder, and this does certainly apply to our business clients. The super guarantee minimums, which were locked in a couple of years ago. So at the moment, super guarantee, every employer in the current year is required to pay 10% of all employee salaries into super. That increases to 10.5% from July. So, July's only a couple of months away. So basically that's already, you could look at it another way, that's already a 0.5% pay rise locked in pretty much for all employees throughout the country, starting 1 July 22. So that rate increases to 10.5%. Then every year for the next couple of years, it sort of creeps up 0.5% until in about 3 years' time, we get to 12%. So where we're going to land in 2025 will be that every employer must pay a minimum of 12% superannuation for all employees, pretty much Australia-wide. So it didn't change in the budget, but fairly timely to remember. And obviously we'll be getting some reminders and that out to our clients and out to our database. But as we get closer to July, just as a reminder to adjust payroll systems and etc., to factor in those higher payments that need to happen from July onwards. Okay, I will talk a very little bit about this. So we're now talking about some of the tax breaks for that more apply for our business clients. I'll talk about this side of things very broadly, just really from a tax perspective, as I sort of mentioned earlier. Sean Edmonds from Digital O2 will chat later about what this might look like practically and a bit more specifically. Okay, so a couple of the big announcements in terms of budget changes were really around these training and extra training and digital deductions. So what that means for any business, first of all, to qualify, your business turnover must be under $50 million a year. So certainly most of our clients are going to qualify for that. It applies for money spent from pretty much budget night onwards. So these measures are already in place today. So if you were to run out tomorrow and spend some money on training or digital adoption, then these extra tax breaks are now in place. Basically what it is, it's 120% tax deduction. So it's your normal tax deduction plus an extra 20% deduction thrown in for good measure. Now, what it means, it doesn't mean 120% cash back. It just means, and this is a common sort of misconception when we talk about the difference between a tax deduction and a tax refund. 120% tax deduction basically means we can claim 120% of it becomes deductible at your, so if we're talking about companies, at your 25% tax rate. In plain English, that means if you're a company paying 25% tax, if you spend $1, every dollar you spend, the tax man will give you back 30 cents. Now, that is better off than you are today without this measure in place. If you spend $1, you only get a 25% saving. So that for dollars in your pocket, that's basically what it means. So as I say, please don't, and I've already had some phone, the reason why I sort of make a point of mentioning that, I have already had a couple of clients call over the last sort of week or so saying, well, if I spend $1, will the government give me $120 back? Or sorry, $1.20 back. Unfortunately, no. It just means you get an extra deduction. You do save a bit more tax, but it's not, the government are not covering the entire cost. So where that becomes relevant, which is certainly the case for most things tax, is it's got to stack up as a business case. We're spending $1 to save 30 cents. So if that doesn't stack up as a business case, you're still 70 cents out of pocket. So it's got to make sense. It's not a case of just saving money, spending money to save tax. The analogy I like to use, and I've looked down the list, I can see my good wife Michelle hasn't logged in. The analogy I like to use is, and I've fell for this over the years, but I'm awake to it now. When Michelle comes home and says, well, if I buy 2 pairs of shoes, they're on sale, that makes it cheaper. Well, I say the accountant in me has worked out that's usually not the case. And that's a little bit the case here as well. It's not we get all our money back by spending more money. Okay, so what is the training? So to get the extra 120% training deduction, it has to be training for employees. So it can't be training for contractors, or can't be training for non-employees. What's going to be interesting there, and the detail or the devil in all of this is always in when we actually get some legislation and we can see the detail, which we don't have yet. But when we can get into the detail of, is a director an employee for the purpose of this? Is a trustee or a beneficiary an employee? So anyway, that will be as we work out more of that detail. But for now, if you're an employee, you are, any training for an employee is eligible. It has to be, the training has to be provided by an entity registered in Australia. So again, with online training now, if you're subscribing to online training courses, then that might just be something to keep an eye on. And it excludes internal or on-the-job training. So again, we haven't seen the fine print on what that means, but it effectively means you're going to have to pay for an external course or provider to provide some training there, and an Australian registered. organisation. Okay, digital adoption. So what's included here? And again, I'm a little bit light on detail simply because all we have, which governments tend to do, so how budgets tend to operate, and I've been through a few of these now over the years. On budget night, you get a whole lot of headlines and you get the 5-minute media grab, but you don't get the detail, the detailed legislation or exactly what that looks like. So we haven't seen that yet. That will come through fairly shortly. So what is the digital adoption measure? So now, compared to the training one, this only covers spending up to June of 23. So training's out to 2024. This one's only 2023. It does apply now. So if you run out and buy your laptop or your cloud-based software from today, then, or from last week, that is included. We think on what we can read, it's any money spent from now. So the obvious question that comes up for a lot of our business clients for cloud-based software is, well, I'm already Xero. Xero is a good example, but a lot of our clients are paying for Xero. Xero is cloud-based software. Will my Xero monthly subscriptions from now onwards be covered by this? And as we read it, the answer is yes. So the same as before, 20% extra deduction. Now that's on top of, and there was a couple of questions came through prior to the session on this. So the extra 20% deduction is in addition to the 100% instant asset write-off. So you go out and buy your laptop, we still get the 100% deduction, and on top of that now we get this extra 20% write-off. One thing, sorry, the second point there, which I did just skip over, how this is going to work practically is a bit messy. If you spend the money now before 30th of June 2022, so over the next couple of months, it does qualify for the concession, but it's not claimed until your next year, your 2023 tax return. And I think that's just down to ATO logistics and practicality, and that the tax office not having to change a hell of a lot of software over the next few months before the 2022 tax software is rolled out. So yeah, it means, yes, you get the deduction, but you may not, when I was joking before about when is the check in the mail, the check may not be in the mail for another 12 months after. So again, we'll see how that plays out practically. Pay-as-you-go installments, a few changes around basically reducing. So pay-as-you-go installments for those taxpayers that pay companies and individuals that pay tax every quarter. Effectively, an installment doesn't change your overall tax. It's a prepayment of tax, for want of a better word. So if you pay more, if your installments are higher throughout the year, you pay less at the end of the year. If your installments are too low during the year, you pay more at the end of the year. It's very simplistically how it works. So again, I sort of approach some of this as a bit of skepticism. It's a cash flow measure only. Reducing your installment now takes a bit of pressure off today's cash flow, which for anyone in business, that's clearly a good thing. We're certainly running a business. Anything that makes that monthly cash flow a little bit more manageable is always a positive. But reducing today's installment simply means you pay a bit more at the end of the year. So overall a positive, but maybe nothing to get too excited about. What is interesting is this third point there. It's a very vague announcement. All the government said was from 2024, you'll be able to base your installment on your accounting software. What we think that's going to mean is you'll download some data out of Xero or MYOB or whatever you're using to run your accounting ledger, and whatever your Xero profit with a couple of adjustments, that will be the number you base your installments on. So look, that probably makes a lot of sense to to link the instalments a little bit more closely to how much profit you're making, and link that back to your zero and your mild ledger. It's all, we certainly see it within our practice and dealing with the ATO on a daily basis. The data the ATO getting, and just the electronic systems and real-time reporting, and if you don't think it's happening, it's happening. Some carbon credits. So primary producers out there, a couple of changes around taxation of primary producers. So to make a few dollars, so primary producers can plant trees and set aside for some land that, from not being cleared, earn a few dollars as carbon credits that can then be sold off. Some changes there. The tax on that is deferred until you realise the sale. And it's also now classed as farm income. So you can now catch it under the income averaging rules and farm management deposits and a few other things for our primary production clients. Employee share schemes have been slightly relaxed a little bit. So the companies can now offer employee share schemes to employees, and as long as the employee's contributing or buying, if you like, less than $30,000 of shares a year, you can now open up those offers for employees. Now, this was a change to the corpse law and the fundraising rules only. There was no tax change here. And then I would argue, and I know a lot of the MBA team that have been involved in this would certainly be well and truly aware. From a tax point of view, these rules are still crazily complex and punitive. Unfortunately, no relaxation there. But very broadly, unless you fall within a couple of narrow exemptions for startup companies and a few others, if you offer shares to your employees, they're all taxed up front, basically as if you'd paid the employee the salary, even though the money's locked away in a share that they may not sell for 5 or 10 years. So it's upfront tax of benefits to staff. So yeah, the rules are still not great. On that front, the patent box doesn't apply often, but I've got it in there largely to fill out the slides, to be honest, as much as anything else, because as I mentioned before, it was almost an uneventful budget. If you're a biotech, a medical or a biotech company, there's some rules where you can pay tax at a lower rate. Look, I'm sure it's a good thing to encourage development and R&D. Those rules have been expanded now to include low emission technologies, agricultural and veterinary chemical products, plant breeders as well. So yeah, those rules have been extended. They only apply for patents issued, so income after July 2023, and it's pretty specific the way the rules apply. It's the patent has to be issued after May of 2021. Sorry, and the other change there, it's been expanded for overseas patents. So if you're earning income in Australia from an overseas patent, you now get the lower tax rates. COVID tests are tax deductible. This had been announced a couple of months back, but it's now it's been sort of confirmed. So from 1 July, so going back now, so from any of us, and I would dare say, given the world we live in, that's probably all of us. For all of us that spent a couple of bucks on our RAT tests or even PCR tests, any money, any expenditure since 1 July 21 on those is now tax deductible and also exempt from FBT if you're buying those for your employees. It has to be linked to work. So the argument is I needed to test to decide whether I could come to work or not, or to work out whether I could attend work. So if you can make that connection now tax deductible. So look, to me, a positive thing. I often think when I see things like this, where something that's common sense should be deductible, it really makes me think, well, possibly if you need to bring in a law to change the current law because the current law doesn't allow it, I don't know. Part of me says, well, does that just say that the current law potentially needs to be fixed? But anyway, it is what it is, and it is now tax deductible, so happy days. What it does mean, obviously, if you don't work, then you can't claim a deduction for them. It is only for approved rapid antigen tests. So I must admit I haven't read the fine print on the box. I have taken a few, but not read the fine print. So I recall reading that it's approved by the TGA, or the Therapeutic Goods Administration. I'm sure that will be on the label there somewhere, probably in font that with me and my eyesight I can't read. Business grants. So there's a lot of business grants, and particularly now, with the recent floods and COVID, and with the million things the world's dealing with, and we as taxpayers and business owners and individuals are dealing with. There's quite a lot of government grants and support out there of a whole lot of multitude of programs. Some of those are taxable, some of those are tax-free. The good news, and I haven't listed them all out here, the only ones I've only listed there a few of the more common ones, and just focusing on the New South Wales, Queensland ones, simply because they apply to the vast majority of our clients. Although we do have a couple of Victorian clients logged in, I do notice looking at the list. So these grants have now been, so there's some there from New South Wales, Accommodation Support Grant, the Commercial Landlord Hardship Grant, the Small Business Support Program. All of those New South Wales grants have now been designated as tax exempt. The Queensland COVID-19 Business Support Grant has been designated as tax exempt. So the long and the short of that is, so for any businesses, if you've received any grants, and a lot of our clients have over the last 2 years or so, some of them will be taxable, some of them will be tax exempt. It's really just a case of going through, working out the specific nature of the grant received, and just stepping through the exact grant received and whether it's in or off the list. If anyone's got any questions on any specific grants, we can obviously deal with those separately. What it does, and again, for all of our business clients, please, depending on what state you're in, a lot of the state governments now have, I was just preparing for this last night, I was just playing around on the Queensland government website. A lot of these, I am off topic a little bit, but I know it's relevant to a lot of our clients. The Queensland government, I know New South Wales do, and there's a federal one for federal grants. There's a multitude of grants out there, anything from apprenticeship support to flood assistance to COVID assistance to training to say a lot of them now escape me. So please, if you're in business, and if anyone wants to drop me a note, I can shoot through the link. So no, the Queensland government does have a good website now. It's called the Queensland Government Grant Finder. So if you just literally jump on there and enter a couple of criteria, it'll sort of filter through the myriad of grants that are floating around and what may or may not apply. Okay, tax administration. So just a couple of, and these are mainly funding changes. So this is mainly the government giving the ATO a bit more money to do a few things. Taxable payment reporting. So any of our clients in the building and construction, couriers, cleaning, security, IT, road freight, any clients, any businesses in those in those categories would already be grappling with the annual taxable payments report. And that's basically a report, end of every year, a list of all the money you've paid out to subcontractors, and submit that report to the ATO. There's talk of that being made from January 2024, of that being made a quarterly report that basically you'll do at the same time as you do your BAS. Probably makes sense. To me, it makes sense to incorporate it as part of the BAS. And sorry, that could be a monthly or a quarterly BAS, depending on your lodgement cycle. Look, to me, probably a common sense measure that just makes all of our lives a little simpler. If the government want a bit of data, just add it all to the one bit of paper I'm already filling in, rather than making me fill in another 3 extra bits of paper. The single touch payroll, these changes, again, are similar in nature. Most of us now will be, whether we realise it or not, submitting our payroll data through STP or single touch payroll to the ATO. And again, that's just about better data to the ATO, employees being able to get their wage and salary and pay-as-you-go withholding data a lot more quicker and a lot more electronically. Again, which is all a positive, which are all fantastic positives to my mind. The proposal is that data also be shared with state government bodies, and effectively that data now becoming your payroll tax reports. Now, it's not quite that simple, because payroll tax is also levied on fringe benefits and a few other things that are not currently included in STP. But again, to me, makes sense. I know at MBA we fill in a multitude of forms every month off to different government bodies. Anything that streamlines that and puts more data together onto one form is a positive. The interesting thing about the STP is the federal government did actually note in it is and the words were quite cryptic. This will be determined by which state governments want to participate. So I don't know why Big Brother just doesn't say you've got to do it, but we could end up with a system where some states decide to do and others don't. But anyway, it's a few years down the track, so we will worry about that when and if it ever happens. Okay, there's a little bit around automating a trust reporting. At a client or a taxpayer level, you won't see any change to this. This is really how the ATO deal with data when they receive it. I loved it. A big part of when you're going through a budget is taking out all the political speak and the electioneering slogans and just getting to the facts or the data. So here's what the ATO say this will mean. This will mean faster return processing and make it easier for taxpayers. Now, here's really what they mean. They can do better data matching of individual and trust returns and work out if you've made a mistake and collect more tax in a faster and more efficient manner. But yeah, again, it makes me laugh, the political spin on, well, we're only doing this to make your life easier. Well, yeah, I don't know. But the cynic in me would suggest it's making the ATO's life easier as well. The last point there, the ATO are extending funding. There's a corporate and trust tax avoidance task force in place. Thankfully, most of our clients do not come into, we've got the odd occasion, but not regularly. Most of our clients don't come into contact with this task force, which, trust me, is a good thing. It's being extended for a couple of years to 2026. The government reckon this is not a bad return on investment if these numbers are right. The government are going to spend another $650 million over 2 years to raise $2 billion or 2.1 billion of extra tax. Yeah, it'd be good to be the government. Okay, fuel. This is the big one. Technically not a tax measure, but obviously front and centre, or front of mind for everyone, all of us, anyone that's got a car at the moment. I won't tell you about my car that's parked up being fixed at the moment. So this doesn't affect me right now because my car's not drivable. But that is entirely another story. Okay, so fuel excise reduction reduced from 44 down to 22 cents a litre. It applied from budget night, so that should all be happening now. As I say, my car is not drivable, so I have not had the pleasure of visiting a servo in the last week, but that should be reflected in fuel prices. It's only a 6-month sugar hit. And again, the cynic in me could say just to get us through an election cycle, but I would not presume to say that. So it's only in place up to the end of September. What is interesting, and again, the flip side of it, the headlines are all, we're saving people money, you're paying less for fuel. What didn't receive the same headlines, but we have quite a few clients that claim back their fuel tax credits. Now, that only applies to heavy vehicles, which I think last time I looked at this, it's vehicles over 4.5 tonne, I think, but don't quote me on that, on public roads or any business use on non-public roads. So, farm equipment, that sort of thing. So because the excise has been reduced, the fuel tax credits or the refunds that these businesses claim, that has also been reduced. And again, that got no headline, which I just find funny. So that fuel tax credit for heavy vehicle use on a public road is now nil for the next 6 months. And for all business use off-road, again, mainly farm or mining sites is the other one, has been reduced from 44 to 22. So there's also less fuel tax credits coming back to some businesses. Fantastic. Well, I will now, Sean, if you're around, I will pass control over to Sean. As I mentioned before, Sean is okay. You there, Sean? You're unmuted.
Yep, I'm here, Michael. Thank you for the opportunity.
An absolute pleasure, mate. To say I will, the running joke at MBA is always the less Michael talks about IT, the safer the world is. So I will hand it over to our IT expert. Yeah, welcome, Sean.
Thanks, Michael. Once again, appreciate it.
No drama.
Won't hold everyone up all day going into a heap of detail regarding this, but just give everyone a bit of an overview of why we believe the government's pushing this agenda. So basically an overview of cybersecurity in Australia. Basically any unauthorised access to any of your electronic devices is basically the rule of thumb with it. Whether it be your phone, your computer, your laptop, even other internet connected devices that don't get much airway in Australia, where baby monitors, things like that, they're all targets for cybersecurity. Cyber attacks around the world, and we've certainly seen the government push this agenda with the increase that we're seeing in the in this space over the last couple of years. Cost of cyber attacks Australia, I'll just cover that briefly on a couple of the more prominent types of attacks that we see. And what's on the rise, and some of the options you should be speaking to your IT provider about to try and protect yourself a bit more and reduce your risk of becoming a statistic. All right. So basically, Cybercrime Reports last year. I'll get that back. Thank you. The government agency that collates all this information reported 67,000 reports last year. On average, obviously, that's one every 8 minutes of the day. Report Cyber recorded losses of more than $33 billion over the same period. Obviously, different industries are affected, have a different factor, but something to think about. The government actually believes we're expecting this to further increase with the way the world is at the moment, with obviously the unrest in Eastern Europe and China. The last couple of years, we've seen a dramatic increase in attacks from both these locations. Part of what I do, I'm involved with a corporation called ASA, who works with the government with legislation and things like that. So we see a bit of back end data out of the government with this sort of thing, and it's pretty massive, the amount of increases, which is why the government's funding it or attempting to fund it. So types of attack that are on the rise. Ransomware is still a significant risk to business. It's gone quiet for a couple of years because they've been focusing on larger targets overseas. Unfortunately, last year there was a couple of attacks on hospitals and councils and school attacks that's caused the ransomware to start focusing back on smaller clients, the SME market, because they don't get the media scrutiny, and obviously then the police attention. Business email compromises are still massive and growing. Average reported loss from BEC, which is business email compromises, was around $50,000 per incident. We see a lot of this obviously in real estate, legal, conveyancing sort of world. So that's obviously where they get the big sugar hit once they get into your email system. It's everyone should be looking at this, whether they use Gmail or free email services or a business solution. There was a media report the other day I noticed of someone that had lost $20-something thousand because their email had been hacked in Brisbane. Spear phishing targeting. So this is a targeted email designed to basically get credentials from a specific person. So they have a database of information. They'll send an email appearing to be from Michael Beddoes to one of his staff, who's trying to basically either get information or money transferred. And the other thing that's on the rise, we're starting to see a lot within the industry, is recruitment. So these bad actors are starting to pay internal people to get access into networks and computer systems to plant software. So some of the things that you can do to improve and reduce your risk of this sort of thing happening to you. All businesses should have some form of managed firewall solution. The routers that you go and buy or comes with your NBN connection aren't up to the task. They have no real security built into them, apart from basic firewall function. Most of these aren't updated regularly. So there's vulnerabilities out there all the time for these sort of devices. It's something that, ultimately people are putting a $100 router in front of their business and expecting it to do the job. It's not the right thing to be done. Business email hardening, whether you use Microsoft 365, Google, or any of those, you should have multiple layers of spam control. Definitely some form of multi-factor authentication. A lot of the systems you can actually reduce limited access either by geolocation or just the services or the type of access within the application itself. All these should be looked at and turned on if possible. Cloud-hosted systems to reduce your risk. So anything that's in most cases cloud-hosted will have far greater security of it built into it. Rather than having computers on your desk and things like that. So a managed multi-factor authentication solution, something that does everything for you. Everyone uses Google Authenticator and Microsoft Authenticator, things like that. They have no backup solution. So when you change phones or lose your phone, it becomes a bit of a nightmare to get into your Xero, your MyOb, and all those sorts of things. Secure monitoring and integrated solutions. So something that actually runs on your system and notifies your IT department or IT provider that there's a problem, rather than relying on your staff to pick things up. Internal training for your staff. So get everyone in a boardroom, show them real world examples of what to look for. And so they're far less likely to fall victim to some of these spear phishing and targeted attacks. And so that's basically all I wanted to say.
Fantastic. Thank you, Sean.
I think we're fighting for control over the slides there for a bit.
I think so. All good. All resolved. Okay, thank you. I was just trying to start my camera up there, but anyway, you've probably seen enough of me for the last hour. I can't believe I've got an hour out of that budget. I appreciate you all for your patience. Just listening to Sean, then I can remember when spear phishing was just grab a snorkel and some goggles in the Brunswick River and try and get yourself a flathead. But clearly I'm a little bit older and the world has moved on. Good stuff. Now, if anyone, I haven't seen any questions come through. Christine, any questions come through the chat box there?
None so far. We do.
Fantastic. There are a couple of, so we did have a couple of pre-submitted questions. And they were mainly around, which I've already touched on, the digital spend. So being able to, and as we understand, although it is early days, we haven't seen the fine print, but as we understand it now, is yes, you can go out and buy your laptop tomorrow, get your 100% instant asset write-off, and also claim your extra 20% deduction. But as I alluded to before, that will then go in your 2023 tax return. The extra 20%. The 100% will go in your 2022 return. So they were the main questions. The other questions were around personal and business tax, which we've dealt with. There was one question around my predictions for the share market and the property market, which I will reply to privately later on. I was honoured that someone would want my opinion of where the share market and the property market are going, but yeah, who knows is the official answer. Excellent. Well, thank you all. In the absence of any other questions, we will call it a day right there. I'm more than happy to forward the slides out to anyone. If anyone wants to just drop me a line or shoot an email through, that's fairly, or even just have a chat to say, probably in a positive way, it was a fairly uneventful budget. And again, part of me probably thinks when you're talking about budgets, then maybe uneventful's good. Excellent. So thank you all. Enjoy your afternoon. Actually, sorry, I have one more slide, don't I, Christine, which I nearly forgot. I had just got, I just got through my wind up and I had forgotten. I just wanted a quick shout out for our charity golf day. So 3rd of June coming up at Royal Pines. So that's our annual fundraiser for the Gold Coast Hospital. So please, we'd love your support. We've already got quite a few clients and supporters and friends of MBA and an MBA team on board, which is absolutely brilliant. Last year, we raised close enough to $50,000. We'd love to hit or improve on that number again. So whether it's playing on the day or sponsoring a hole or just coming to Royal Pines and drinking beer, any of the above, or buying, well, there'll be raffle items, we'll have auctions, etc., etc. So please keep that day available. Christine's details are there. We would love everyone's support on, say, raising a few dollars for the Gold Coast Hospital. Excellent. Now I think I can now officially finish. Enjoy your afternoon and cheers. See you later.